Hello and welcome. In this session, we're going to explore one of the most powerful tools in a manager's financial toolkit, cost volume, profit, or CVP analysis. We'll go beyond the basic numbers to see how you can use CVP to model business scenarios, make critical decisions, and ultimately drive strategy. Let's start with a scenario that I'm sure many of you as current or future business leaders can appreciate. Meet Prem, the founder of a startup called Acoustic Concepts. His product, the Sonic Blaster speaker, is a huge success. But with that success comes a new set of complex and slightly worrying questions. He's asking things like, what if a new competitor enters the market and my sales start to slip? How far can they fall before we start losing money? Or, the marketing team is pushing for a bigger budget and a price drop to boost sales, but how do I know if the increased volume will actually make us more profitable? These are not just numbers problems, they are strategic dilemmas. The challenge is moving from guesswork to a data-driven strategy, and CVP analysis is the framework that allows us to do just that. So, what exactly is CVP analysis? At its core, it's a model that helps us estimate how our profits are affected by changes in five key levers: selling prices, sales volume, our unit variable costs, our total fixed costs, and, in a multi-product company, the mix of products we sell. Now, to make the model manageable, we do have to start with a few simplifying assumptions, such as assuming that prices and costs will remain constant over a relevant range of activity. The key takeaway for you is this: CVP is your toolkit for modeling financial outcomes. It allows you to play out different scenarios and make strategic decisions with a much clearer understanding of the potential financial impact. To effectively use CVP, we first need to look at our financials through a different lens. That means setting aside the traditional GAAP income statement that you'd see in an annual report. For internal decision-making, we need an income statement that separates costs based on their behavior, variable versus fixed. This brings us to the most important number in CVP analysis, the contribution margin. The contribution margin is the amount of revenue left over to cover your fixed expenses after you've paid for all of your variable expenses. The formula is simple: sales minus variable expenses. For our case study, Acoustic Concepts, each $250 speaker they sell generates $100 in contribution margin. That $100 is what's available to help cover their monthly fixed costs, and then once those are covered, to generate profit. We can take the contribution margin concept a step further by calculating the contribution margin ratio, or CM ratio. The CM ratio tells you what percentage of each sales dollar is available to contribute to covering fixed costs and then to profit. Acoustic Concepts has a CM ratio of 40%. This means that for every single dollar of sales, 40 cents is contribution margin. The other 60 cents is used to cover the variable cost of the product. Now, why does this matter? Because it's a powerful shortcut for what-if analysis. For instance, if you anticipate a $50,000 increase in sales next quarter, you can instantly estimate that your profit will increase by $20,000. That's 40% of $50,000. Assuming, of course, that your fixed costs remain the same. It's a quick and powerful tool for analysis. Now let's move into the practical applications. The first and most fundamental is calculating the break-even point. This is the sales level, in either units or dollars, at which your profit is exactly zero. Think of it as your company's minimum survival target. Using the formula method, we can calculate the unit sales needed to break even by dividing our fixed expenses by our unit contribution margin. For Acoustic Concepts, that's their $35,000 in fixed expenses divided by the $100 unit contribution margin, which gives us 350 speakers per month. Now, I want you to pause and think about this for a moment. Imagine you're the VP of sales, and you already know from market data that you can reliably sell at least 400 units a month. How does knowing that your break-even point is 350 units affect your confidence and your strategic approach to pricing and promotions? Breaking even is essential for survival, but of course, the goal of any business is to generate profit. Target profit analysis allows us to calculate the sales level needed to achieve a specific profit goal. The formula is a simple extension of our break-even formula. We take our target profit, add it to our fixed expenses, and then divide the whole thing by our unit contribution margin. If Acoustic Concepts wants to achieve a target profit of $40,000, we add that to the $35,000 in fixed costs and divide by $100. The result is 750 speakers per month. And I want to emphasize that this isn't just an academic calculation. This number becomes the foundation for setting sales quotas, for allocating marketing budgets, and for managing the expectations of investors and stakeholders. Our next application, operating leverage, is a concept that is absolutely critical for understanding a company's risk profile. The degree of operating leverage is a measure that tells you how sensitive your net operating income is to a percentage change in sales. We calculate it by dividing the contribution margin by the net operating income. For Acoustic Concepts, that's $40,000 divided by $5,000, which gives us a degree of operating leverage of 8. So, what does that number 8 actually mean? It means that a 12.5% increase in sales will result in a 100% increase in profit. That's 8 times 12.5%. It acts as an amplifier. But operating leverage is a double-edged sword. High leverage, which is caused by a high fixed cost structure, is fantastic when sales are growing. But it's incredibly dangerous when sales are falling. A small percentage drop in sales can be amplified into a huge percentage drop in profits, potentially wiping them out entirely. This is the tool that quantifies the exact risk that Prem was worried about at the beginning. CVP analysis also provides us with a set of flexible profit equations to rapidly answer those what-if questions that come up in meetings all the time. For example, Prem wants to know what happens to profit if he sells 450 units instead of the current 400. We can solve this in several ways. We could use the detailed equation, price times quantity minus variable cost times quantity minus fixed expenses. Or we could use the simpler version, unit contribution margin times quantity minus fixed expenses. Or, if we only have summary data, we can use the third version, CM ratio times total sales dollars minus fixed expenses. As you can see, all three equations arrive at the same revised profit of $10,000. The key here is flexibility. A manager who understands their CM ratio can make very quick profit estimates without having to break down all the per unit data. So, to conclude, it's clear that CVP analysis is much more than just a set of accounting formulas. It is a strategic framework that every effective manager should master. It allows you to translate business risk into quantifiable numbers. It gives you the power to set meaningful sales targets for your teams. It helps you critically evaluate different pricing strategies and cost structures. And it provides you with the hard data you need to either justify or reject proposals, like a new marketing campaign. By truly understanding these relationships, you can lead with greater confidence, turning complex business problems into clear, actionable, and profitable plans.